Hello listeners, this is Abhishek Lahoti, Assistant Vice President at ICRA Limited, and through this podcast, I will be sharing ICRA's view on recent RBI's bank lending framework for REITs. The Reserve Bank of India's June 2026 circular on lending to REITs represents a pivotal shift in India's commercial real estate financing landscape. For the first time, banks are formally allowed to lend to SEBI-registered listed REITs subject to clearly defined safeguards on asset quality, governance, and cash flow visibility. The framework requires that at least 80% of the underlying assets generate stable operating cash flows, ensuring that lending is anchored in income-producing portfolios rather than development risk. This marks a transition towards more institutionalized and diversified funding model for REITs, which have historically relied on capital markets. A key strength of the framework lies in its prudential discipline. The RBI has introduced an aggregate bank exposure cap of 49% of the REIT's asset value, along with restriction on bullet or back-ended repayment structures to prevent refinancing stress. In addition, the requirement for full security coverage through charge on underlying asset, assignment of rental cash flows, and escrow mechanisms provides lender with strong structural protection. These safeguards ensure that while bank credit flows increase, systematic risk remains tightly controlled through conservative leverage and robust collateral frameworks. One of the most immediate outcomes of the circular is the unlocking of refinancing opportunities of nearly Rs 26,000 crore for office REITs as per ICRA's research, primarily driven by upcoming NCD maturities over FY27 and beyond. This creates a significant shift in liability management. Access to bank funding can provide longer tenure debt, competitive pricing, and diversification away from capital markets, thereby improving financial flexibility and reducing refinancing risk for REITs. Beyond refinancing, the framework opens up substantial incremental debt funding potential. The listed office REITs currently operate at a gross LTV of around 24%, well below the 49% regulatory ceiling. Even a calibrated increase to 40% LTV could unlock additional bank funding of Rs 75,000 to 80,000 crore, supporting acquisition-led growth and portfolio expansion. This dual benefit, refinancing plus growth capital, positions REIT for accelerated scale-up while maintaining prudent leverage. To conclude, the RBI's framework creates a safer and more balanced way for REITs to access bank funding. It improves financial flexibility, supports growth, and opens a stable, cash flow-backed asset class for lenders, signaling a more mature real estate market. Thank you for listening and stay tuned for our upcoming podcast.